So learning objective 3 teaches you that these plant assets, right, they don't last forever. So what happens when it comes to the point where the business disposes of the asset? And when we say dispose, we really mean one of three things. Disposal could mean we sell it to another party. Disposal could be that we simply scrap it. We retire it. It's no longer useful to anybody. Or it could be exchanged for a newer, piece of equipment. So when we say dispose, that's what we mean. Okay. In accounting, we have to note that date of disposal because literally, once we decide to take a piece of equipment out of the business, right, regardless how we do it, we have to take it off the books. We have to take it off the books. So what this shows you is that we have to do a couple of things. To take a piece of equipment off the books, we have to we're going to credit the equipment account. We also need to debit the accumulated depreciation account for that equipment, okay? But that's not all we do, because when we get rid of a piece of equipment, we have to do two things. We have to compare the book value of the equipment, right, which is on our balance sheet, the book value, compare with the proceeds if we sell the equipment, okay? So, for example, if you go back to the small delivery truck for Bill's Pizza, at the end of the 5-year period, it was said to have $1,000 salvage value, which after 5 years would also be its book value. And Bill's Pizza decides to sell that. So whatever they sell it for would be the proceeds. So say they sell it for, $1,200, right? In this case, the proceeds are greater than the book value. So when the proceeds are greater than the book value, they have to recognize a gain on the disposal of an asset. Gains go on the income statement. You probably remember the multi-step income statement where there's that other section, the other revenue and gains, and other expenses and losses. That's where this would go. That $200 difference would show up as a gain. Okay, but let's say that we couldn't get $200 for it. Let's say we couldn't get anything for it. we just scrapped it. Well, the proceeds would be zero. We have a book value of $1,000. And so again, when our proceeds are less than the book value, we recognize a loss on that disposal. So you have to know about gains and losses being the difference between the proceeds, if there's any, and the book value of the asset that's being sold or retired, what have you. You're comparing those two numbers to find out if there's a gain or a loss. Okay. So let me just go to this information here from a company that had office furniture on their books. They had office furniture for $60,000. That's the asset. They had accumulated depreciation on that furniture of $49,000. So that means on the balance sheet, the book value of the furniture was $11,000. So that's the book value. If they received $16,000 from selling that furniture, that's $5,000 more than the book value. And so we would have to recognize that $5,000 as a gain on the disposal of a plant asset. The gains, again, go on the income statement for that year. Very important to know. Okay. In the case of selling, it's the same office furniture with the same book value, okay, but instead this company sells it for $9,000 instead of $16,000. So the proceeds would be $9,000. The book value is $11,000. right? So that means that they need to recognize a $2,000 loss on the disposal of this office furniture. Losses get recognized on the income statement. Okay, and that's basically again, don't need to do much of any accounting on this. It's really conceptual and understanding what happens to it. The do it exercise in the back of Learning Objective 3 again reiterates the issue of what happens when a plant asset is disposed of. Here we have a company who had an old truck. The cost of the truck is $30,000. Accumulated depreciation is $16,000. Now remember, the cost minus the accumulated depreciation, as you know from last objective, is the book value, right? So the book value of this truck is $30,000 minus $16,000, or $14,000. So you have to know the book value. Two possible things could happen. The first thing is they sell the truck for 17. So 17,000 would be the proceeds. 14,000 is the book value. They're getting $3,000 more than the book value. So what would they have to do? They'd have to recognize a gain of $3,000 in the first one. If the second situation happened where they've deemed the truck worthless and simply junks it, what would happen? Well, they would be getting zero for this truck. So the proceeds in essence would be zero. The truck has a book value of $14,000, $30,000 cost minus accumulated depreciation of 16. It's got a $14,000 book value. The entire book value would have to be recognized as a loss. They would lose $14,000 if they retired the truck. Okay, so that's what you have to know. That's what you're going to have to be able to figure out. I'm not emphasizing the journal entries so much as the concept. You understand how these are disposed. You understand how to calculate your book value, compare it with proceeds, and see if you have a gain or a loss. And that gain and the loss or loss goes on the income statement. Okay. Learning Objective 4 is all about intangible assets. And I can't tell you how important intangible assets are, because many of the largest businesses that you know are run on intangible assets. Now, what do we mean by that? So intangible assets is really about the government recognized ownership for an individual or a company, right? Being a right or a privilege or an advantage that you own either an invention, so a patent is government recognition of an invention. Apple is built on patents, okay? Apple started many moons ago, right, with their their Apple computer. That was a patented, right? They owned that, so only Apple can make it. The patent provides ownership, and that ownership means that only the company who owns it can make it. So, you know, they, of course, now they have patents for their most popular products, be it an iPhone 12, be it the MacBook, be it other types of things. Those are all intangible assets in which they are the rightful, lawful owners of an invention. Okay. Those inventions don't always have to last forever. Most patents have what we consider a limited life. Patents are usually granted for up to 20 years. And no more than 20 years. However, you can renew a patent, but I don't know why you would, right? Would it make any sense for Apple, for example, to renew a patent on the original iPod, where the music used to be on this little individual, you know, piece of equipment that you could carry around. No, there's no need for it anymore. It's not. It's all incorporated in the phones and in their computers. So there's no need to have it. No one's going to make an iPod. Those days are over. So some inventions simply have a limited life. In which case the next set of inventions is basically going to take its place. Okay, so that's important to sort of know. However, there are certain types of intangible assets that have what we call an indefinite life. And of course, that means a lot longer. So let me go on to copyrights. So a copyright basically is, again, government recognized ownership. This usually affects things that are written. So whether it's a book, whether it's music, whether it's computer code, whether it's a cartoon character, these types of things can be owned or copywritten material. Could be broadcasting, could be other types of things like this. So copyrights are those types of rights. So for a singer, for an author, these copyrights have, in essence, an indefinite life. So for a book, for example, if you're an author of a book, you have that copyright for the rest of your life, plus 70 years after you're dead. Okay. After that 70-year period is done, it becomes part of what we call the public domain. There's no copyright on things like Shakespeare or Beethoven or Bach anymore. Right? Those copyrights have long expired. So that's what would happen in that sense. So for musicians and artists, this is extremely important today. You have performers, whether it's, I'll just pick Lady Gaga just out of the blue here, or Beyonce. They own their music for their entire life, plus 7 years after their death, which means that no one can use their music without permission. The copyright permission normally is you have to pay the artist to play the song, or to sing it at a certain, you pay to play, basically. So that's the business. That's the business. Even though you might hear lots of music on, whether you watch particular stations on YouTube, or whether you're on Pandora or Spotify or other types of, or if you have Sirius Radio, they're all paying the artists for permission to broadcast their music, because that's how they make money. That's how they make money. So their expense is to pay the artist permission to use their music and things like this. So it's a business model that's extremely important to sort of understand. And this is the reason why when you're writing papers in English class, and you basically use other information from other people, whether it's a quote or whether it's data or whatnot, you have to have a reference for that, right? Because the reference means you're honoring the copyright. And you're not claiming it as your own. And that's a problem, right? That's plagiarism. For software, right? Copyright software. All software is copywritten. Whether it's a Google search engine, whether it's Microsoft or any of the other pieces of software that it's out there, it's all copywritten. They're owned. So the only way you use it is to usually buy a license to use it. It's normally the business model there. Copyrights are really important because, again, if you can prove ownership, you can start a business around it. Okay, because the only way other people get to use it is with your permission, and that permission is in the form of a payment. Okay. Franchises and licenses, these are also intangible assets, and they're very, very important ones that have a lot of value. I'll start with something that a lot of people do. They'll watch professional sports, whether that's Major League Baseball, whether that's the NBA, NHL, um, NFL, or any of the other professional sports leagues. I will tell you that Major League Baseball owns all of the teams. We just had Mr. Cohen buy the New York Mets. He didn't buy the Mets. He bought the franchise. He bought the franchise of the New York Mets. That means that the New York Mets, like all the other ball teams in the league, Yankees, Sox, etc., they are owned by Major League Baseball. And the only way you get to have your own team is to get them to give you a franchise. Okay. And franchises are privileges and advantages under contract that you have to do things certain ways. Otherwise, they take your franchise license away. Now, whether it's a large venue like Major League Baseball or the NFL, or even smaller ones, you've dealt with franchises all of your life without maybe knowing it or not. Gas stations that you go to tend to be franchises. If you've ever stayed at a hotel, be it a Marriott or a Hilton or even a Days Inn or Motel 6, those are all franchised. You've probably been to a McDonald's or a Subway or a Wendy's. They're all franchised. So that means that the people who are running their local franchise are, yes, they're the owners of the franchise, yes, but they don't own the business. They just have a license and a contract to run it in this particular area. They still have to follow the rules of the folks who own Wendy's or McDonald's or Subway. They are the ones who tell all the franchisees, this is how you make the sandwich. This is how long you cook this. This is how much we use for ketchup and mustard on our burger. So I mean, it's dictated through contract how everything has to go. You probably, if you live in this area and go down Route 9 quite often, you probably noticed another franchise that didn't do so well called Golden Corral. Golden Corral was a franchise. Now, the original franchisee, the original owner of the contract for the franchise, didn't follow the franchise rules, didn't follow the contract. So the corporation pulled the franchise, told that guy, we're not doing business with you. You no longer have the franchise. And so that it closed down the first time because of that. Then they found an owner. They found someone to buy that franchise, so they granted that. And of course, then COVID hit. There was just bad luck on the part of the second owner. But these are very important contracts to follow. You can't do anything without it being expressly written in the contract or permission from the owner. Okay. That's why Major League Baseball has to approve new owners for new teams, because Major League Baseball owns all the teams, and you're just buying a franchise, right? So, a very interesting type of thing there. Trademarks and trade names kind of go into the same category, but a trademark is could be a symbol. For something. So like if you look at McDonald's, they have the golden arches. That's a trademark of McDonald's. If you look at Walmart and they have that weird little star thing, whatever it is, that's a trademark. Walmart owns that. Dunkin' Donuts owns their trademark, that cup with the DD on it and little steam coming out of it or whatever the hell's coming out of it. That's a trademark. In fact, they even own the Dunkin' Donuts letters as their trademark, with the exact font and coloring of those letters. It's all owned. It's not unusual to find trademarks on anything. whether it's Coca-Cola or Pepsi, they have their trademarks. Um, you know, Mobile, Shell, you know, wherever you go shopping, they'll have their trademarks. That means that they own that type of symbol or whatnot. Very, very important. The same thing with trade names, very much like trademarks. These are rights given for a trade name. So trade names could be something as simple as like a Kleenex. Now, when you want a tissue, you say, I need a Kleenex. So a Kleenex is a trade name. You might not necessarily have a Kleenex brand tissue. You might have any ordinary tissue given to you, but because you're so used to calling it Kleenex. Or a Band-Aid, I need a Band-Aid. Well, a Band-Aid is a brand. It's a trade name owned by a company. It doesn't mean that every time you get a Band-Aid, it's a Band-Aid, right? It's because it's not made by the same company. It's a bandage, but we're so used to calling it Band-Aids because it's a trade name. Artists have their trade names as well. So, Lady Gaga that's a trade name. I don't think she was born Lady Gaga. I don't think Madonna was born Madonna. Or even, I hate to say, I don't even know if people were born with letters like X. I have no idea. I don't think so. I really don't think so. They develop trade names, so they have their own way of branding themselves, right? But believe it or not, it can be an ownership right. It can be an ownership right. The last type of intangible asset you need to be familiar with is something called goodwill. Goodwill. The best way to explain goodwill is through a story like this. Let's say Matt wanted to say I have a barbershop. I have a business. It's in Poughkeepsie. I've been cutting hair for many years. I have an awesome location, awesome reputation, a client list a mile long, etc. But I only have $100,000 worth of assets. And Matt decides to pay me $200,000 for my business. So he's paying $200,000 for $100,000 of assets. How does he account for the extra $100,000? That's what goodwill is. What he's paying for above and beyond the value of the assets is my reputation, which is not on the balance sheet. Includes my host of my clientele, my list of clients, which is not on the balance sheet, but very valuable. He might also be paying for, the fact that he's taken over my employees, which are all top-notch, barbers in the area. So he's getting quite a deal above and beyond the assets, and he's paying for that. He would show it as goodwill. Here's probably a really good example. So Disney, I'm sure you're all familiar with Disney. All those Disney characters, by the way, are owned by Disney through copyright. Okay, so whether you talk early on Mickey Mouse and Winnie the Pooh, or some of the newer ones, whether it's Frozen or other types of things that they're doing. Those characters are owned by Disney through copyright. And so Disney had a problem maybe 10, 15 years ago. They were doing really well with young kids. And then when kids started getting around 10 or so, 10 years old or older, into their teenage years too, they would switch over to the Cartoon Network or Nickelodeon because the characters there were more their style. That way, Disney couldn't figure that out. They didn't want to lose that group of watchers, and so they went out and bought Marvel. They bought Marvel first. They overpaid for Marvel. They paid billions of dollars for Marvel. So let's say Marvel was worth $1 billion. Disney paid $5 billion. The extra $4 billion they paid was Goodwill. Another year or two later, they bought the Star Wars Lucasfilms. They bought all the Star Wars characters. And again, they overpaid for that too. So again, the overpayment for those assets would be considered goodwill. So Disney is, sometimes if you can't create a character, you can always go out and buy one. That's what I say. Okay. So those are important. Just one thing, a couple of other quick notes here. When we say some assets, some intangible assets have a limited life, which means they might only be useful for 5 years, et cetera. Well, then a company can actually go through a process. It's similar to depreciation, but depreciation is for fixed assets. Amortization is for intangible assets. So amortization works like straight line depreciation, but it's specific to an intangible asset that has a limited life. So that's important to sort of know. Otherwise, there are some intangible assets that have what we consider an indefinite life. There's no foreseeable limit on how long this thing could last. So whether that's a search engine like Google, a piece of software, a Disney character, or a logo, so forth. So in that case, if it's indefinite, there's no amortization. Okay. A couple of other quick little notes here too on patents. Patents are good for a 20-year period, and I just want to explain a little bit why we have such high drug prices in the United States. The most common culprit of high prices, as you know, is if there's no competition in a field. And so when a drug company creates whether it's a vaccine like for COVID, or a pill that can cure something that couldn't be cured before, the patent gives them the exclusive right to manufacture it and sell it. So they're the only company who can manufacture and sell that vaccine or that drug for this period of 20 years. So that's what we call a monopoly. And when you are a monopoly, you're the only seller of a product, particularly if it's a life-changing product or even a life-saving product. You can charge whatever the hell you want. And regardless whether it's ethical or not, I'm not saying it is, this is how that business works. And so the reason that we pay the highest drug prices in the world often relies on the fact that we do have these breakthrough, inventions, breakthrough drugs and treatments. And the price we pay for those breakthroughs is we live with monopolies for a time. What happens after that 20-year period of time is done? The patent is not, for a drug company, a patent cannot be renewed. And that's where it becomes a generic drug. So you might have had someone say, well, choose the generic drug because it's a lot cheaper. So what a generic drug is a drug whose patent has expired. So thus anybody can make it. So that's why aspirin, Tylenol, Motrin, Advil, that's why those are so cheap. Those patents have long expired. Any manufacturer can make it. And once you have a lot of businesses making a product, you have a lot of supply, prices come down. So you have very cheap drug prices for you can get a bottle of aspirin for $1, at a dollar store. So, it's very, very cheap. But what these patents do, particularly for these newer drugs, is it creates that monopoly. No one else can make it. And thus that company can charge whatever they really want to charge for it. And so I just want to explain a little bit from a business model, how that works and how it's affecting you or what you might have heard of. Okay. Whew. Okay, so the book gives you an example, but we're not going to be doing any amortization here. Research and development is talked about a lot, but it's simply expensed whenever it happens. Again, that copyright piece, very important. It's good for the life of the creator, plus 70 years after they're dead. You might have remember this particular song.
Everybody get up.
Um, Robin Thicke and Company had this. This is a very big hit back when they released it. The problem was that beat and the beat that goes woo in the background there. That was copywritten material from a group that created that way back in the 70s. Okay. And Robin Thicke and Company did not ask permission or pay for use of that. So they got sued in court. And because the group actually had the copyright to show the court they owned it, Robin Thicke and Company, which they made a pretty good penny on that song, had to fork over many, many Benjamins to the group. Okay. So again, that's the right of ownership. If you can prove you own it and someone took it, right, it's easy to get compensated for your loss. If you don't own it, it's hard. But you say someone stole it, then you got to prove you owned it. So it's very, very important that happens. Yeah, we talked about trademarks and trade names, whether it's Kleenex or I'll have a Coke or I'll have whatever, lots of things. These can be renewed as often as you need. Okay. As often as you need to. Talked a little bit about franchises already and Goodwill. Okay. So for learning objective 4, they just simply want you to be able to identify and explain what all these terms are. And we just went through all these terms. So no problem. That's really the focus on learning objective 4. Pretty straightforward. Learning objective 5 does two things. It first shows you a little up close on the balance sheet for property, plant, and equipment and intangible assets. And then we're going to do some analysis to close this part. So first you have property, plant, and equipment. This is Coca-Cola, partial balance sheet. As you see here, this is usually how it's listed. Remember, the land is usually listed first because land is property. Buildings are usually listed after that because buildings are what we used to call plant. Machinery and equipment is equipment. So property, plant, and equipment is the category of assets, and oftentimes that's exactly how they are usually listed on their balance sheets. Here you have the accumulated depreciation. Intangible assets don't tend to have as much of a of an order. Here you have Coke has a lot of trademarks, be it the big C or other types of things. They plus the word Coke in essence. Very important trademarks. Indefinite lives, they're going to keep those forever. Coke has bought other products. They went out. They just were a soft beverage company. They went out and bought some juice. They went out and bought some water. They went and bought other things because they needed to expand their product line. And so they overpaid for a lot of those. So you have Goodwill. And all those Coca-Cola bottlers are actually franchises granted by Coca-Cola to those franchisees to bottle all their stuff up. Okay. So important to sort of understand that. Two pieces of analysis we're going to look at here. Return on assets is very important. And what do we mean by a return on assets? Well, if you look at your total assets, they should be generating a profit. So we simply look at net profit over average total assets. That gives us our return on assets. When you look at JetBlue for 2014 data, they had a $515 million profit on average total assets of around, $7.5 billion. So that was a 6.8% return on assets for JetBlue in that particular year, which was excellent. That meant that for every dollar in average total assets, they generated almost a 7-cent profit for each dollar of total assets they have. That's really exceptional. When you look at, particularly when you look at their previous year, 2013, they only had a 2.3% return on assets, up to a 6.8. So they're doing some great stuff there. Southwest Airlines for the same year, they can feel pretty proud. They had a 5.7% return on assets. In other words, they had roughly almost a 6-cent profit for every dollar in average total assets. So they were doing quite well. That's well above the industry. The industry, all the airlines put together, when you look at all the airlines, they're averaging only a 4% return. Southwest is doing really, really great. And then JetBlue is traveling and flying at well over 30,000 feet, my friend. That's a pretty high rate. The last one we're going to look at is something called asset turnover. And asset turnover is using your assets to generate sales. I mean, that's why you have those buildings and machinery, equipment, et cetera. You want to generate sales. You want to sell your products. So how are they doing? So asset turnover is your net sales divided by the same average total assets we looked at in the last ratio. So for JetBlue in 2014, they had 5.8 billion in net sales over about 7.5 billion in average total assets for an asset turnover of 0.77 times. One way to look at that or interpret that is they roughly generated about 77 cents of sales for every dollar in average total assets. Okay, that's good. Clearly that went up from the previous year, so they're doing better. You see their assets are being utilized more efficiently because they're generating more sales. However, you've got to tip your hat to Southwest Airlines. Look at this asset turnover, 0.94 times, well above both JetBlue and the industry average, which is hovering at 0.8. They are really generating a lot of sales from their average total assets, 0.94 times. In other words, roughly speaking, about 94 cents of sales for every dollar in total assets. Incredibly good, higher than the industry as well. So those two are important. Don't have to worry about profit margin. We've looked at profit margin already. So let's just look at how our asset turnover would look at the do it exercise here. We have Paramore. They reported a profit of 180,000. They had net sales of 420. They had total assets of 460 on January the 1st, and on December 31st, 540. So these two numbers need to be averaged for your average total assets. Okay. Determine the asset turnover rate for 2017. Net sales was 420 divided by average total assets. So beginning and ending assets divided by 2 gives you an average. Their asset turnover, 0.84 times, very good in general. Okay. So that's basically the rest of the chapter. I think it's relatively straightforward. Any questions?